Alright, listen. Over the past few days, something quietly dramatic happened in financial markets. After heavy selling pressure, US tech stocks suddenly surged, the Nasdaq climbed, buyers rushed back in, and the headline explanation was simple. Markets recovered after a sell-off driven by concerns over massive AI spending. But that explanation is incomplete because when markets reversed this quickly, the real story is rarely confidence returned. Sometimes a rally tells you more about fear than optimism. So today, let's take a wider look because this rebound may be revealing something structural about modern markets, something investors are only beginning to understand. First, let's understand the scale. Before interpreting a move, we measure it. The Nasdaq is heavily weighted toward mega cap tech companies whose combined market capitalization exceeds 10 to 12 trillion dollars, depending on the cycle. When stocks that large swing, it isn't just trading, it is capital reallocating at planetary scale. Remember, a 1% move in mega cap tech can represent hundreds of billions of dollars in market value shifting. That is not noise, that is institutional behavior. So the real question becomes, why did institutions step back in so quickly? Let's now have a closer look into the fear beneath the selling. Let's start with what triggered the sell-off. Concerns about vast AI spending. Now, at first glance, this sounds irrational. Why would markets fear investment in the most transformative technology of our generation? Because markets don't reward innovation immediately. They reward cash flow visibility. And here is the uncomfortable truth. The AI arms race is extraordinarily expensive. Major hyperscalers are spending tens of billions annually on data centers, GPUs, power infrastructure, cooling, networking. Some estimates suggest AI infrastructure spending across large tech firms could exceed $200 billion annually within a few years. That is not incremental spending, that is industrial era scale capital deployment. When companies spend this aggressively, markets begin asking a dangerous question: where is the return? Not eventually, but predictably. Markets hate uncertainty more than they hate risk. So why did stocks suddenly rally? Now, this is where we go deeper because rebounds rarely happen for just one reason. Mechanism 1. Positioning. Modern markets are heavily influenced by institutional positioning. When too many funds lean bearish, even a small positive shift forces them to buy back exposure. This is known as a position unwind. It can create rallies that look like optimism but are actually mechanical. Think of it less as investors running toward the future and more as traders running away from being wrong. Mechanism 2. Liquidity reflex. Here is something most retail investors never see. Markets today are reflexive systems. Prices influence behavior, behavior influences prices. If stocks fall too fast, systematic funds reduce exposure. If volatility stabilizes, those same funds buy back in. This creates what looks like confidence, but is often just liquidity responding to rules, not emotion, not belief, structure. Mechanism 3. The AI narrative itself. Ironically, the same AI spending that triggered fear is also preventing deeper declines. Why? Because large investors are terrified of missing the next technological platform shift. Historically, platform shifts, electricity competing the internet, created enormous long-term winners. So even when valuations look stretched, capital hesitates to exit completely. This creates a market psychology defined by one powerful force: fear of missing out at institutional scale, not retail FOMO, institutional FOMO, much larger, much more stabilizing. So what this rally really signals, now we zoom out to see that, because the wider look is never about one rally, it is about regime change, and here is the regime emerging. We are entering an era where the largest corporations on earth are behaving less like software firms and more like infrastructure builders. Think about it. AI requires power grids, semiconductor supply chains, rare earth inputs, cooling systems, land. This is no longer purely digital growth, it is physical expansion. almost industrial, and when companies become infrastructure investors, their risk profile changes. Growth becomes heavier, slower, more capital intensive. Markets are still adjusting to this reality. A brave observation most analysts won't say clearly. Let me offer you something slightly uncomfortable. The AI boom may be less similar to the software revolution and more similar to the railroad era. Huge upfront investment, long payoff cycles, enormous eventual productivity, but also periods of financial overreach. Historically, infrastructure booms often produced extreme winners, spectacular failures, and volatile markets in between. So, when you see tech stocks swing violently, you may actually be watching the birth pains of a new economic architecture, not instability, transformation. So, is this rally bullish? Here is why we must be disciplined. A rebound after heavy selling is not automatically bullish. Sometimes it signals resilience, sometimes it signals fragility, and in this case, it may signal both. Resilience, because capital still believes in the AI feature. Fragility, because that feature is becoming extraordinarily expensive. Markets are beginning to price that tension. Let's come to my forward-looking view now. Let me give you a rational projection. Not hype, not fear, just structure. Over the next several years, expect larger swings in mega cap tech. Why? Because when companies deploy capital at historic scale, small changes in expectations create massive valuation adjustments. Volatility will not disappear. It will normalize at a higher level. But here is the key. As long as AI remains perceived as a productivity revolution, capital will keep returning. Not smoothly, but persistently. So what is the untold story behind this rebound? It is not simply optimism. It is not simply relief. It is the market negotiating a new reality that the future will be built, but it will be expensive. And expensive features require patient capital. So if you're asking whether this rally signals strength, the better question is, are investors prepared for the financial weight of the AI age? Because the defining feature of the next decade may not be technological brilliance, but capital intensity. The companies that survive won't just innovate best, they will finance best. That is the wider look, because markets don't just react, they reveal. Stay sharp.